We're clearly looking at a very different world from the one that we saw even 6 months ago. Right now we have a serious increase in risk aversion and investor jitters throughout the world, and this has begun to affect developing countries, something that hadn't been the case earlier. As a result, we've seen capital flows to developing countries decline by almost 50%, and we're really beginning to see some of these effects in terms of activity. We have developing countries, the major developing countries, offering slower growth now than they were earlier, and that happening at the same time as Europe enters into recession offers a pretty worrisome conjuncture. The situation for developing countries, I think, is one of vulnerability. Obviously, what's happening in Europe, were it to deteriorate significantly, is going to have important impacts for developing countries. We run some scenarios here where, were that crisis to become more serious, growth in developing countries could decline by almost some 4 percentage points, GDP be lower by 4 percentage points. That's a very significant slowdown, sort of something on the lines of what we saw during 2008, 2009 following Lehman's. Developing countries really have to prepare for the unexpected, if you wish. And what we're really suggesting for them to do is take a look at their current situation, take a look at their current spending, and take a cold, hard look at what might happen and plan ahead a little bit. If there are countries that have important amounts of financing to go in the months and years ahead, maybe now's the time to pre-finance that debt, prepare the loans, get that money coming in while financial markets are still relatively active. If they have fiscal plans that might be constrained in the case of a serious downturn, they need to go in, prioritize their spending, and really do some contingency planning to figure out what they want to preserve and what they might let go in the case of a sharp slowdown. It is one of 5.5% growth, the lowest growth in the last 10 years if we exclude 2009. So that's a pessimistic story. But nevertheless, it does, even for that outcome to occur, require that a number of things go right. And as we've been indicating, there's a lot that could go wrong, and in those kinds of scenarios, we could be looking at a much worse outcome. If we do see one of these downturn scenarios, we could see commodity prices heavily affected. In 2008, 2009, oil prices fell by some 40%, metal and mineral prices by almost as much. In our simulations, we see oil prices potentially declining by as much as 20%. That's going to have important impacts for the fiscal balances of oil exporting countries. It's going to have important impacts also for countries that are important exporters of metals and minerals. On the other hand, it's going to be a positive for importers of those commodities. So there's a little bit of a trade-off here. It's going to be something that cushions the effects for many developing countries, but it's going to be one that accentuates the risks for those countries that are reliant on those exports.